Hello, everybody. Hope you're all doing well. So, anyway, a few days ago, I talked about how it looked like the financials were really starting to weaken up, and sure enough, they did. Now, when something like this happens, people always ask me, like, did people know that this bank was going to go under? Yeah, I mean, I'm sure people there had some kind of an idea, um, but are they big enough to really move the markets? That's the one bank. I mean, I don't know. It's the $1 million question, right? It's the chicken or the egg thing. But anyway, I think there's a chance now that financials might bounce. So here's our financial spider. This is an ETF that tracks the financial sector of the market. All right. And one of the reasons why I thought we were going lower is because we had this initial sell off, and then, well, this was resistance up here. This $36 level was important. And what happens when something's at resistance, right? Resistance is here, here. When market's going higher, there's not enough supply to fill all the demand, or there's not enough sell orders to fill all of the buy orders. So buyers are forced to pay a premium to entice sellers to come into the market, right? When we get to a resistance level, well, that means that there's a lot of investors who are looking to sell at or around the same price. In this case, it was 36. Now, some of these investors who want to sell start to get the sense that, oh boy, there might be other sellers around here. That's why the market's not going any higher. And they start to get worried and they say, wow, I wanted to sell my stock or my shares at 36, but there's a lot of other sellers coming into the market now. They might knock it down, and my sell order at 36 might not work. I mean, if someone's willing to sell it at 35.90, why would they come to me if I'm trying to sell it at 36? They're going to go to whoever has the lowest price. So the sellers start undercutting each other, and it becomes a snowball effect. Okay, and we broke through this level of support, and it was support here. Support is the opposite of resistance. When a market's going lower, there's not enough demand to absorb all of the supply. So the buyers are, I'm sorry, the sellers, oh boy, now I got myself confused. It's been such a long day. All right, so when the market's going lower, it's because there's not enough demand to absorb all the supply. But when we get to a support level, there is. Now, this level was support for a few days, but then this broke. And when a support level breaks, it means the price gets below it. And that tells us something. It tells us that the investors who created the support with their buy orders are out of their market. Maybe they canceled their orders, maybe they finished their orders. We don't know. But frequently, when a support level breaks, we tend to make these big moves lower. Now, we could be setting up here for a bounce. Now, I don't know what's going to happen long term. I get the feeling that this thing is really going to spread, and we haven't seen the end of it. But we're really oversold. Now, this is what we call the RSI momentum indicator. Momentum is a measurement of how far a particular security has moved from time period A to time period B. Most of the time, markets trade within their typical or normal or usual trading ranges. If we get below that, we call it oversold, and if we get above it, we call it overbought. This is important because these conditions attract traders into the market. If something's oversold, they're going to expect a reversion to the mean, which means a move higher. If something's overbought, they're going to expect a reversion to the mean, which means a move lower. A lot of Wall Street trading strategies are built on this concept of reversion to the mean. So right now, the financial sector is just about as oversold as it was at the very bottom of the COVID crash in March of 20. So it's a principle of markets that oversold markets that get to support tend to bounce. Now, why do I think there will be support here? Well, notice how it was support here. Okay. In financial markets, we have to understand that some price levels are more important than others. That's just one of the basic principles of markets. Okay. And if you don't understand that, you're going to have a hard time being a successful trader. But if you do understand it, it's going to make your job a lot easier. Now, back here, this 36 level last year was support, and it converted into resistance here. How does that happen? Well, there are people who bought here who regret doing so when the price went lower. And they tell themselves, if I can get out at break even, I'm going to. So when the price got back up to where they bought, they placed their sell orders. And if there's enough of these sell orders, the level that was support can turn into resistance. Now notice how the $36 level was important as here as well. It was support again. How could resistance become support? This is due to seller's remorse. People sold and they regret doing so when the price goes higher. So they tell themselves they're going to buy their shares back. And if there's enough remorseful sellers, they're going to buy their shares back, but they're only going to do so if they can get them for the same price that they were sold at. So if we have enough remorseful sellers placing buy orders at their sell price, the level that was resistance could convert into support. And that's what happened here. And then it converted back into resistance. And now I think there's a good chance there's going to be some support here. And because we're so oversold, there's a chance we can bounce. This 32.70 level is important for some reason. I don't know why. Just like this $36 level was important. So in financial markets, some levels are more important than others. And at stockmarketjobber.com, we don't focus on weird, esoteric, silly stuff like Fibonacci theory. We focus on what people in the institutional trading world look at. Now, I was in the institutional trading world for 20 years, so I speak to someone with firsthand knowledge. And I could tell you with 100% certainty that at the big hedge funds or the big institutional funds, no one's looking at these esoteric methods like Elliott wave or whatever. We're looking at, hey, is this thing overbought? Is this thing oversold? Where do the buyers come alive? Will give you a little Wall Street talk. Where do the buyers come alive? Well, maybe around 32.70. This is the support level. Where do the sellers come alive? That's a resistance level. That's asking someone, where is the resistance? So we focus on price levels, trends, and momentum, and psychology. And that's what we talk about at stockmarketjobber.com. All right, and I'm going to show you one of the reasons why we kind of thought this was coming. Now notice this is the insurance industry. So the industry is part of the sector. So this ETF tracks the insurance industry. Notice how resistance converted into support. That's what we just talked about. Resistance here, support here. Seller's remorse. People sell, price goes higher. They tell themselves they're going to buy it back, but only if they can get it for the same price they sold it at. Now, it became support. Once this support breaks, what does that tell us? Well, it tells us that the investors who created the support are out of the market. Whenever you take demand out of a market, regardless of what market it is, I don't care if you're talking about stocks or if you're talking about shoes or anything, paint. I mean, you name it. If you take demand out of the market, the sellers are going to have to push the price down. They're going to have to offer their shares at a discount to get buyers to come in and off the sidelines. And sure enough, that's what happened. Now we're down to this important level here that was support. And a lot of times, levels that were support or resistance, they can stay intact for a long time. Like we could see right here that this back here was a resistance level that stayed intact for a long time. This down here was a support level that stayed intact. So the important levels can be support, and they could have what we call market memory. They can stay intact for a long time. Same thing with a resistance level. And an important thing to understand about markets too is the way that these levels can shift back and forth from support to resistance and resistance to support. But anyway, a lot of times when we get to a support level and we're oversold, we tend to bounce. So this part of the market looks like it could bounce too. Now, that doesn't necessarily mean to buy it, all right? Now, I don't want to confuse you, but here's the thing. Just because we're oversold and at support doesn't mean we can't keep going lower. So now you're probably saying, well, what the hell am I supposed to do, Mark? Well, here's the thing. If you want to trade, what you do is you actually wait for the reversal to start before you jump in, right? You're not going to get the best price, but you're not going to get run over either. It's going to put the odds in your favor. It's going to make the risk-reward ratio better. So now what I would say, when would I jump into this if I was considering trading it? I'd probably wait for it to get back up above this level where it opened today. Now, I'm not going to get the bottom price, but there's a chance we keep going lower. So you let the market tell you what to do. I'm not guessing. Once the reverse starts, well, then I'll jump in. If you just try to catch the bottom, you're just guessing, and that's not a good way to make money. That's actually an excellent way to lose money. All right, let's look at another sector here. Our capital market sector, kind of the same thing. Sorry about this, folks. Just trying to get my pen up here. We can see that the level that was resistance converted into support. And when the support broke, we got the big move down. Now we're at a level, $80. People like nice round levels. This level was resistance. There's a good chance it converts into support. We're oversold. So this might set up for a bounce. So one of the things we do at Stock Market Jobber is If we want to kind of get an insight as to what's going to happen with the broad market, the S&P 500, we look at the 11 sectors that it's composed of. If we want to get an idea of what's going on with the sectors, we look at the industries that are in the sectors, and that's what we're doing here. So we have two parts of the sector that look like they could potentially bounce. So again, doesn't mean they're going to. We have to wait for the reversal to start before you jump in. Part of being a trader is not worrying about being perfect. You're just supposed to worry about making money. And if this thing bounces and you say, all right, well, you know what, I'm not going to get into it until it gets back to, say, just hypothetically $82. Well, if it gets to 82 and goes to 84, you just made a profit. You can't sit there and think like, oh, I should have bought it at 80. I'm second guessing myself. It sounds very counterintuitive, but your job as a trader is, don't think of it as your job is to make money. Think of it as your job is to develop a strategy that makes money and then stick to the strategy. It's the hardest thing for people to do is sticking to the strategy, because when you have real money on the line, it makes you do irrational things. And fear of losing a profit makes traders do the two worst things they can, and that's selling their winners too early and uh, holding on to their losers for too long, right? So the way trading works, if you're a day trader or a prop trader, I mean a proprietary trader trading a firm's money, well, if you have a loss, you got to just take it quick. If you have a winner, you got to let it run until it gets to your price target. Now, it's not that easy, because when there's money on the table, people start to get afraid. And fear makes us do things that we shouldn't do, right? So you're afraid, you got a little loss, you're afraid that it's going to get, it's you don't want to take the loss, you're afraid, so you just hold on to it and it just gets bigger and bigger and bigger. Or you say you want to buy a stock at 20 and sell it at 30. Well, it gets to 25, you start thinking, oh boy, I'm up 5 points here. I don't want to lose this profit. I'm going to sell, and then you sell it, and then you watch it go to 30. Turns out you were right, and you left $5 on the table. So successful trading is about psychology, and when we look at charts, we're looking at psychology. We're looking at seller's remorse, buyer's remorse. When something gets oversold, it shows really emotional fear. Something gets overbought, tells us there's euphoria going on. So this is the opposite, right? Overbought, we got to resistance and we sold off. So down here, look at this level, right? Support level. We were oversold, got to support, and we rallied. All right, now if the market does keep going lower, and we'll know more on Monday, obviously, so make sure you check back. And this is one of the things I talked about 2 days ago when I said if you think the financials are going lower and you're not an options trader, you can look at this ETF. This ETF is designed to move 3 times the amount of the financial sector of the market, but inverse to it. So while the financials are melting down, just in the last 4 days, this sector is up 30%, or this ETF is up 30%. So another thing we do at the Stock Market Jobber is we figure out ways to get exposure to different parts of the market, and we talk about these inverse ETFs a lot. Now, you have to be careful, because if you're wrong, you'll lose your money 3 times as fast, but if you're right, it's a nice thing to have. All right, thanks everybody. I'm going to get going, and I will see you soon. Make sure you check back, and please subscribe to our YouTube page, and I will talk to you soon. Thanks, everyone.